Spotting institutional supply and demand zones. The secret to turning into a consistently profitable trader. The majority of what you believe you understand about supply and demand just scratches the surface. If you can master. If you're able to master supply and demand, you'll be aligned with where institutional capital flows, instead of standing on the opposing, making you vulnerable to getting caught in a trap. And that's exactly what we'll explore in this video. We're pushing past the theory and thoroughly unpacking supply and demand step by step. We'll walk through the essential ideas and principles you need to grasp, from beginner fundamentals to advanced techniques. Your support means a lot, so don't forget to hit the like button and subscribe if you're new around here. Catch you right after this. Let's quickly clarify the meaning of supply and demand in a currency pair trading session. Supply is the quantity of a currency that's available in the market for trading. Supply refers to the amount of a currency available for trading. In the Forex market, when we mention supply, we're talking about how much of a specific currency, such as the US dollar or the euro, is circulating and ready to be exchanged. When there's a large amount of currency in circulation, it indicates a high supply. On the flip side, we have demand. Demand reflects how much traders and investors are willing to purchase a currency. When a large number of people want to buy a currency, it indicates high demand. If the demand for a currency increases while the supply stays constant, the currency's price will rise. Conversely, if the supply increases while demand holds steady, the price will fall. When there's a major imbalance between supply and demand, the price will keep shifting until it encounters sufficient liquidity to restore balance. For instance, if buyers significantly outnumber sellers in the market, the price will surge upward rapidly until it hits a supply zone capable of absorbing that demand, which then helps restore price balance. Every time a buy order is placed in the market, there must be a seller on the other end to complete that transaction, and the same goes in reverse. These interactions are what influence the movement of currency pair prices. Buyers generate demand, pushing prices up, while sellers contribute supply, placing downward pressure on prices. This constant push and pull is what fuels price fluctuations. Across any currency pair, millions of trades are carried out by a wide array of market participants, from individual retail traders to major financial institutions. This trading activity leads to imbalances in the supply and demand of the currency pair. These behaviors and levels of participation also shape the overall order flow within the market, which is what prints the price action on our charts. Each currency pair has a unique order flow in every trading session, recording the behavior of all participants. By analyzing this order flow, we can detect the actions of financial institutions and decode their strategies, allowing us to make high probability forecasts about the price's future movements. Remember, financial institutions cannot hide their footprints in the order flow, providing us with valuable. Gaining insights into their behavior reveals that the market operates as a continuous cycle, always striving to correct supply and demand imbalances by gravitating toward liquidity zones. As mentioned earlier, institutions can't conceal their order flow or the major imbalances they generate in the market. By learning to spot these footprints on a chart, we can align our trades with the direction of institutional money flow, preventing ourselves from being caught on the wrong side and becoming part of the liquidation process. One of the most reliable and secure ways to trade alongside financial institutions and track their order flow is by accurately identifying supply and demand zones on the price chart. Now, let's take a look at how these supply and demand areas form in the market before price typically moves. Before the market makes a significant move, price often consolidates or trades sideways within a tight range on the chart, commonly referred to as the base. This phase serves as a brief pause, giving the market time to build momentum. During this stage, the market draws in more participants, both retail traders and large institutions, contributing liquidity and laying the groundwork for the upcoming price movement. For instance, in a bullish scenario, the price makes a sharp upward move and breaks through the base zone. This is triggered by an abrupt and intense surge in buying activity, creating a strong imbalance between supply and demand. As a result, price accelerates upward, exiting the base in search of liquidity to absorb enough supply and correct the recent surge in demand. This is exactly how demand zones are established. To capitalize on this, we should wait for the price to revisit the demand zone, then apply our entry strategies to initiate long positions, putting us in alignment with institutional traders. So why does price respond to a demand zone and bounce from it? The primary reason it retraces and tests the demand zone is that there's insufficient buying pressure to sustain the upward move. price seeks out new supply to absorb and meets existing demand, resulting in a pullback. The reversal from the demand zone occurs because of institutional activity in that area. Previous institutional buyers initiated long positions there and aim to protect those entries from falling below their break-even levels to maintain profitability. Simply put, institutional players actively defend their long positions. These zones are respected because banks and large financial institutions scale into trades in phases, particularly where their earlier entries have left visible imprints. Since not all of their orders are filled initially, they often wait for price to return to those areas to complete their positions. That's why we must be patient and let price revisit these supply or demand zones before taking trades, if we want to follow the institutional flow rather than get caught and trapped on the wrong side. All of these market processes unfold in 4 distinct phases. The base, where price consolidates and builds momentum. The expansion, marked by a sharp rally or drop due to imbalance. Retracement and mitigation, where price revisits the base to fill unexecuted orders. The continuation, the final phase where the trend resumes with strength. As traders, our primary focus should always be on the continuation phase. That's where we aim to enter the market, aligned with institutional flow and the prevailing trend. The same principles apply when a supply zone is established. Price consolidates within a base, then a spike in selling pressure creates a noticeable imbalance between supply and demand. As a consequence, the price aggressively declines, breaking beneath the base. Afterward, price revisits the supply zone to trigger any remaining institutional short entries and to neutralize the imbalance between supply and demand. Before the market resumes its bearish order flow, it fills those unexecuted positions. To trade short with the direction of institutional capital, we must wait for price to return to the base and supply area. At that point, we can evaluate potential short setups as smart money re-engages in the market. The price then continues to move lower, developing new base formations along the way. This cycle repeats, creating fresh supply zones during the ongoing downtrend, until the bearish momentum eventually slows down. How do we apply supply and demand within smart money concepts or ICT methodology? First, understand that the market is fractal. What happens on a lower time frame also plays out on higher ones. Price behavior such as trends, consolidation, and reversals appear consistent whether you're looking at the 1-minute chart, the daily chart, or the monthly chart. For instance, if a demand zone appears on a 1-minute chart, and then we shift to a higher time frame. When we shift to a higher time frame, like the 15-minute chart, we may notice that the entire base formation from the 1-minute chart condenses into a single bearish candle that precedes a strong upward move. This is what we identify as a bullish order block. In contrast, during a bearish setup, the base seen on a lower time frame may appear as a single bullish candle on the higher time frame, positioned just before the market drops, known as a bearish order block. The order block is the last buying or selling candle that forms just before a rally upward movement or a drop downward movement expansion. Essentially, the order block is a single candle that appears right before market makers and institutional money decide to manipulate the market by creating a shift in market structure or driving a drastic trend continuation. Now, what are the main types of supply and demand? Supply and demand zone formations can be categorized into different types, including reversal patterns, continuation patterns, and flip patterns. Let's begin with the trend reversal base, a pattern that signals a potential shift in market structure, either from bullish to bearish or bearish to bullish. This reversal base typically manifests in 2 primary forms. Drop base rally. In this setup, price initially drops and then consolidates within a narrow range, forming the base. Shortly after, buying momentum surges, creating a strong imbalance in favor of demand. The price breaks out of the base to the upside, confirming a trend reversal from bearish to bullish. Traders often look to go long when price revisits this base, now acting as a demand zone, to position themselves alongside institutional flow. Rally base drop. Conversely, in this pattern, the market rallies first, then enters a sideways consolidation forming the base. Following that, significant selling pressure emerges, breaking the base to the downside. This signals a possible shift from a bullish to a bearish trend. Here, traders typically wait for price to return to the base, which now serves as a supply zone, before considering short positions in alignment with smart money activity. The second core pattern in supply and demand trading is the continuation pattern, which suggests that the price is likely to maintain its current directional momentum after a temporary pause. This pattern is essential for trend-following strategies and institutional alignment. It occurs in 2 common forms. 1. Drop base drop. This bearish continuation pattern begins with a sharp decline in price, followed by a short consolidation phase, forming the base. This pause reflects temporary equilibrium before a renewed wave of selling pressure pushes the price even lower, breaking the base with strong bearish momentum. To capitalize on this structure, traders anticipate a pullback into the supply zone, the base, which presents a low-risk entry point to ride the downtrend in alignment with institutional selling. 2. Rally base rally. On the bullish side, this pattern starts with a strong upward move, followed by sideways movement that creates a base. The market then breaks above this base with continued buying strength, signaling sustained bullish sentiment. When price returns to this demand zone, smart money traders look to enter long positions, aiming to align with ongoing institutional accumulation and take part in the continuation of the uptrend. The third key pattern in supply and demand theory is the flip pattern, a powerful signal of a market direction shift. This pattern is particularly favored by professional traders due to its high probability of catching early reversals backed by institutional activity. Anti-clockwise arrows. What is the flip pattern? A flip pattern occurs when price reacts to a supply or demand zone, showing respect initially, but then breaks through that same zone, signaling that the balance of power between buyers and sellers has shifted. In essence, it shows that the role of a zone has flipped, from supply to demand or vice versa. Repeat button. 2 common flip scenarios: supply flips to demand, bearish to bullish reversal, price taps into a supply zone and begins to decline. However, demand aggressively enters the market, absorbing all supply. Price breaks above the supply zone, turning it into a new demand zone. On the retest of this flipped zone, traders look to enter long, aligning with the fresh bullish order flow. Demand flips to supply, bullish to bearish reversal, price reacts to a demand zone, showing an initial bounce. Selling pressure builds, and price breaks below the demand zone. This zone now acts as a resistance or supply zone. On the retest, institutional traders may enter short positions, anticipating further downside. Brain. Why the flip pattern matters. The flip pattern reflects a real-time shift in institutional interest. It's a footprint that shows where smart money is absorbing liquidity and flipping zones to trap retail traders. Mastering this concept allows you to spot early entries before a major move unfolds, with clear risk management around the flip zone. Generally, a flip pattern occurs when a previous supply or demand zone is violated in the opposite direction, resulting in a change in its market role, from supply to demand or vice versa. These shifts are referred to as flip zones, and they reflect a fundamental change in market sentiment and order flow. Flip patterns are typically categorized into 2 key types. Repeat button. 1. Demand to supply flip. This pattern usually forms when the market is in an uptrend, printing a sequence of higher highs. Eventually, the price fails to form a new high and pulls back into the most recent demand zone. Initially, there might be a minor bullish reaction, but as selling pressure increases, price breaks below the demand zone. This signals a trend reversal from bullish to bearish. Once the zone is broken, its characteristic changes. The previous demand zone becomes a new supply zone. If price retraces to this zone, it's likely to mitigate it before continuing its bearish momentum, offering an opportunity for a short entry aligned with institutional order flow. Repeat button. 2. Supply to demand flip, reversed concept. In this case, a supply zone is broken to the upside due to strong buying pressure. The zone's role flips to become a demand zone. On the retracement, this new demand zone becomes an area of interest to look for long entries, aligning with continued bullish momentum. It's important to understand that not every break of a zone qualifies as a true flip pattern. Successful trading of flip zones requires clear rules, confirmation signals, and contextual alignment with the broader market structure. These advanced filters and criteria will be explored in upcoming lessons. But for now, let's move on and learn how to recognize valid supply and demand zones using candlestick formations. There are 3 distinct methods to mark supply and demand zones using candlestick patterns. The first technique emphasizes identifying candles confined within a range. The second technique centers around the pivot candle, while the third utilizes a fractal formation as the designated supply or demand zone. In the first approach, for establishing a legitimate supply and demand zone. In the first technique for marking a valid supply or demand zone, attention is given to the candles within the consolidation range right before the price breaks out of that zone with a sharp expansion move. In the first technique for marking a valid supply and demand zone, attention is given to the candles confined within the range, occurring right before the price breaks out of that zone with a powerful impulsive move. The second technique, referred to as the pivot zone, takes place where a reversal in price results from either a single candle or a two-candle sequence formed just ahead of a notable bullish or bearish expansion. You can define this zone using one engulfed candle created right before a strong price movement, or you might include the second candle as well, depending on the context of price action and how cautiously you approach entries. For a demand zone, this typically involves identifying the final bearish candle, essentially the last selling candle, before a rapid upward move, where the next candle closes above its high. This reflects a classic sell to buy pattern. Conversely, in a supply zone, it's usually the last bullish candle, the final buying candle, before a sharp price drop, with the next candle closing below its low. This represents a traditional buy to sell formation. You can opt for any of these outlined methods when plotting your supply and demand zones, but it's crucial to understand that each approach comes with its own set of advantages and drawbacks. For instance, using the range zone as your reference may lead to a wider stop loss, potentially reducing your risk-to-reward ratio. However, this also means you're less likely to miss trading opportunities. Alternatively, refining a range zone into a pivot zone allows for a narrower stop loss and an improved reward-to-risk setup, though it may increase the likelihood of missed trades. There isn't a universally superior method for plotting supply and demand zones or for executing trades, since successful outcomes depend on various factors. Every trader operates with a unique perspective, and the strategy that proves profitable for one may not yield the same results for another. Ultimately, the foundation of a high-probability trading system lies in consistent execution. Adhering to the rules and conditions you've developed through market experience is essential. Both techniques can serve effectively in detecting valid supply and demand zones. The third method for mapping out supply and demand zones is the fractal model, which is segmented into three distinct variations. The fractal model is the third method for identifying supply and demand zones, and it is categorized into three variations. The first category of the fractal approach is the inside bar formation. This takes shape during strong impulsive moves where the price fails to exceed the high or low of the previous candle, essentially forming a consolidation zone on a smaller time frame. The second variation of the fractal method is known as the sell to buy or buy to sell wick areas. In bullish conditions, when the market surges aggressively, candles may show no clear pullbacks within that time frame, just strong momentum bars without an identifiable demand zone. However, the candle wicks often reflect a retracement or range from a lower time frame, pointing to a hidden pivot or consolidation demand zone. The same logic applies in a bearish setup, where wicks between higher timeframe candles denote a lower timeframe range, indicating a supply zone. The third type of fractal zone is defined when the price prints large wicks. Here, you can fine-tune your broader pivot supply or demand zones by isolating the candle's wick instead of considering the entire candle. These wicks typically represent minor pivots or micro ranges on a lower time frame. This wraps up our foundational explanation of how to identify and draw supply and demand zones. Now let's go over some key insights and practical tips for spotting high-probability supply and demand zones. A major element in evaluating the strength of a supply or demand zone is analyzing the intensity and candle structure of the price during the impulse move away from that zone. The more aggressively price departs from a zone, the more significant the imbalance between buyers and sellers at that level. This often reflects institutional level orders executed by smart money in that region, increasing the probability that price will respect and respond to the zone on a retest. As demonstrated in the examples, when the strength of the impulse wave fades, the reliability of the associated supply zone also declines. The most dominant supply zone in the examples is the one tied to the sharpest and most forceful bearish expansion. The second factor to assess is how long the price remains within a supply or demand zone. The shorter the duration price stays at a zone, the more significant the imbalance between supply and demand at that level, signaling a more forceful entry by smart money. In general, the quicker the price moves away from a level, the stronger and more reliable that zone becomes. The third element to take into account is how fresh the base zone is. Every time the price revisits and mitigates a supply or demand area, the available supply or demand within that zone diminishes, reducing its overall strength. In this session, we've explored the foundational and advanced principles of supply and demand zones, the underlying market psychology, and techniques for accurate identification. In the upcoming segment of this video, we'll guide you through spotting institutional supply and demand zones and applying them to enhance a profitable strategy and make successful trades. Thanks for tuning in. I hope the content proved insightful and useful. Be sure to subscribe and turn on notifications so you won't miss out on our latest updates. We'd love to hear your thoughts and input, so drop a comment below and let us know which topics you'd like to see featured in future content. Your support means a lot, and we'll catch you in the next episode.